Good afternoon and welcome to today's Trust and Estates webinar, Life Insurance and Trusts, Power Tools of Estate Planning. This webinar is brought to you by Life Insurance Trust Company. I'm Susan Lipp, Editor-in-Chief of Trust and Estates, and I'll be your moderator today. In a moment, I'll be turning things over to our speakers, but first let me explain how you could get the most out of this event. To improve your viewing and listening experience, you can move your webcast windows around by dragging on the title bar or resize them by clicking on their lower right corner. At the bottom of your screen, you'll find multiple application widgets. By clicking on these buttons, you can open and close widgets on your screen. A copy of a white paper is available for download in the resource list widget. This webcast has been accepted for 1 CE credit hour towards the AEP designation program. The live broadcast of this event has been approved for 1 CFP Board CE credit hour. Investment and Wealth Institute has accepted this program for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. Instructions for credit submittal are available in the resource list widget. For those attorneys in the audience getting CLE credit, please listen for a code word that will be stated at some point during the webinar. To get your credit, you'll need to put that code word into the survey that appears at the end of the webinar. You can also include your bar number and state of practice to receive the CLE credit. You can open the survey at any time by clicking on the survey widget on your screen. Again, please note that the CLE credit pertains only to attorneys, and the CLE credit is pending. We welcome questions about our topic and will answer as many as we can following the presentation, but feel free to submit yours to the queue at any time. Just type it into the Q&A window on the left-hand side of your screen and hit the submit button. Please be aware that today's session is being recorded and will be available for on-demand viewing. You'll be notified by email when the archive is available. Before we get started, I'm going to turn the floor over to Leon Wessels, Corporate Business Development Manager at Life Insurance Trust Company, for some opening comments.
Thank you, Susan, and welcome everyone, and thank you for attending today's webinar. My name is Leon Wessels, as Susan had said, and I represent Life Insurance Trust Company, which is located in Sioux Falls, South Dakota. I'm also pleased to be joined by my longtime colleague, John Barkhurst, from our affiliate company, Insurance Trust Monitor, or better known as ITM 21st. We're pleased to be sponsoring today's event. John will provide a few closing remarks following the presentation, and I also want to thank Susan and Jill and their team from Trust and Estates for hosting the event today, and most of all for their help, guidance, and support, which have been greatly appreciated. Having been raised on a farm and spending the first 40 years of my life in Northeast Iowa, I am a firm believer in a well-known phrase, if you build it, they will come. This past summer, baseball and the world witnessed a fulfillment of that phrase when the White Sox squared off against the Yankees in the Field of Dreams located in a nearby Northeast Iowa cornfield. In a way, John and I have experienced our own Field of Dreams as it relates to trust-owned life insurance. Over the past 20 years, ITM 21st became the largest provider of IVAD administration and TOLI review services in the country. And a few years ago, we actually launched the idea to create our own exclusive life insurance trust-only trust company. We argued that if we built it, they would come, and indeed they have. In 2017, we received a charter in South Dakota for Life Insurance Trust Company, otherwise known as LITCO, and in 4 short years, we've become the largest trustee of insurance trusts. We have completed over 20 acquisitions and enjoy strategic partnerships with numerous banks, trust companies, law firms, and advisors who utilize LITCO as the trustee for their high net worth clients' insurance trusts. We have a unique yet simple business philosophy. Focus on one thing and do it exceptionally well at a competitive price. Respect all referring sources, the banks, the attorneys, the CPAs, advisors, and then treat them extremely well. And last, to ensure each of our clients, which are the grantors and the beneficiaries, receive the service, care, and asset protection they expect and deserve. So if you or your clients possess an ILET or perhaps plan to create one in the future, we hope that you will reach out to us so that we may send you some additional information on why LitCo should be your choice when naming an ILET trustee. Please check the audience resource area today on your screen. There's a white paper available for those of you who are interested. It's titled, "When Naming Your ILET Trustee, Did You Make the Easy Decision or the Right Decision?" I do hope you enjoy our session today, which is being presented by two incredibly talented and knowledgeable insurance professionals, not to mention two of the nicest people you will ever meet, in Ken Samuelson and Kristen Belay. So let's get the show started. Susan, back to you. Susan, I think you're muted.
Sorry about that. I always tell speakers.
Yeah, we're missing our good introduction.
So I'm sorry about that. I'll introduce the speakers. We have Kristen Belay, who is Senior Vice President of Strategic Resources for NFP and Partners Financial, and Kenneth Samuelson, President and CEO of the Moorhead Group. And you can find more information about today's speakers by clicking on the speaker bio widget at the bottom of your screen. And with that, I'm going to turn things over to Ken.
Thank you very much. First of all, I want to again thank the Life Insurance Trust Company for their invitation for Kristen and I to present today. It's a real privilege. Before I get to the agenda, I want to start with a story that I think will set the stage for our discussion today, and it goes back about 15 years. It was summertime, and I decided to assign myself a summertime task to go out and interview attorneys, CPAs, and trust officers about life insurance. They all had experience sitting at the table while life insurance was being considered by their client, and I really wanted to understand what it looked like from their point of view, what they liked, what they disliked about the product, and what they liked and disliked about the process. It was fascinating, and I learned a lot, and they had real opinions. In the course of those interviews, I learned a lot of information, but one thing stood out to me like a neon sign. During the interviews, literally every one of them volunteered that they were a little bit self-conscious when they said it, but they didn't really fully understand life insurance like they wanted to. Let me qualify that. They certainly said they felt like they understood some of the basic elements of how to use life insurance, and they were familiar with what cash value is and the difference between term insurance and permanent insurance, but not a lot beyond that. And that really surprised me. So, and just like on today's call, I was talking to highly skilled professionals that had been around the product called life insurance for years, but they really wanted help in understanding it better. So our goal today is to enhance your understanding of what life insurance is, why it works, and how to be able to give real guidance to clients as they consider using life insurance as part of their estate plan. That's our mission. So we'll blow through the disclosures. You're certainly free to read those later at your leisure. But let's take a look at today's agenda. Life insurance and how it works. We're going to go over some fundamental underlying characteristics that make it different than any other kind of asset. The types of life insurance. Often life insurance looks like a mass of confusing product types, and it's hard to discern what to use for what purpose. I hope to be able to unravel that today and give you some handy tools to help you understand the types of life insurance and, more importantly, when and why to use what. And the rationale for life insurance. In this section, we're going to walk through why wealthy families, many of whom are very liquid, use life insurance. That's what I'll cover. Kristen's going to cover the modern strategies for the use of life insurance and how advisors actually use the product in specific scenarios. We'll talk about current legislative issues, and then we'll talk about considerations for selecting a trustee, because often life insurance is owned by a trust. So with that ambitious agenda, let's jump in. You know, I've often said and there's a great video on YouTube by Simon Sinek called Start With Why. So we're going to start with why, because that's always a good place to start. Why life insurance? So let's set this up. Let's say a client walks into your office, and let's say that they have $1 million estate tax liability, due it at death. The client wants to establish an irrevocable trust funded with $1 million. and they want to explore their choices for creating that $1 million, and they want to look at non-insurance versus insurance choices. Now, let's start with a logical non-insurance choice, a sinking fund inside the island. So let's dismiss life insurance for a minute and just talk about a sinking fund. In that scenario, they have to deal with three variables. Longevity risk, in other words, how many years do they have to fund this pot of money? Investment rate risk, i.e., they have to assume that they'll earn a certain return over time to get the $1 million. And tax risk, meaning whatever they accumulate is exposed to income and capital gains tax. We all know that trusts are taxed unfavorably, so that they have to account for the tax headwinds during the time they're accumulating the money. So let's talk about longevity risk for just a minute. We have to assume that we have a reliable period of time to accumulate the funds if we're doing a sinking fund. And the first logical question is, what is my life expectancy, or what is the life expectancy of the client we're talking about? So let's assume it's a 65-year-old male, and the mortality table says that a 65-year-old male has a life expectancy to age 90. And this is from the most recent mortality table. So we can assume that we have until age 90 to accumulate the money. And if we have a relatively conservative constant return of 5% pre-tax and a 40% environment, 3%, then that means we'll use those assumptions and we will be able to accumulate the money, and it's all very simple. So what kind of number does that generate? Well, here's the sinking fund analysis, as simple as it is. How to accumulate $1 million after tax, assuming it's a 3% after tax return. You have to deposit $26,000 per year annually to accumulate $1 million. That's easy. All done, right? Well, perhaps it's not so easy, and perhaps that bears a closer look. This is one of the most common misconceptions that we see about people's understanding of life expectancy in the mortality table. So let's start with a pool of 65-year-olds. At age 90, 50% of them would still be alive, and 50% would not be alive or deceased. So we have to make sure that our sample client is in the 50% group that's still alive if we're going to do a sinking fund. And unfortunately, nobody can control that, which is what longevity risk is all about. So in an extreme example, let's go back to the previous slide. If the client happened to die at the 5-year mark, then we would only have $145,000 worth of value in the fund, or 14%. And this would be a near total complete failure of the plan. So in order to manage mortality risk, if we're doing a sinking fund better and more reliably, we need to re-examine this mortality curve. So if we want to have a higher probability of success, perhaps we need to fund the trust more quickly. Maybe we could fund it 1 standard deviation back, which would be right about here, and or even 2 standard deviations to the left, so that we have an even higher percentage chance of success. So here's what it looks like to fund to age 85 or even 80 if we want a higher success percentage. So there's the sinking fund analysis to age 90. If we compact that back to fund to 85, then it takes $36,000 per year. And if we compact it beyond that to 1 standard deviation back to age 80, it takes $52,000 per year. And that still only gives us a 2/3 probability that it will work. So that's what it looks like if we're trying to do it without life insurance. So let's take a look at why life insurance may drive a different outcome. And by the way, for the attorneys in the audience, the code word is finance. Again, the code word is finance. So let's look at the fundamentals of life insurance. I said a minute ago that that mortality is very unpredictable, which is true if we're only looking at one life. But that causes us to have to look at a very, very important concept which undergirds all of life insurance, called the law of large numbers. The first thing that I want to point out is we're talking about the law of large numbers. We're not talking about the concept of large numbers or the idea of large numbers. It's really the law of large numbers, just like the laws of physics or the laws of gravity. And so what is the law of large numbers? I hate reading slides, but let's read this to be sure we understand. In probability theory, the law of large numbers is a theorem that describes the result of performing the same experiment a large number of times. According to the law, the average of the results obtained from a large number of trials should be close to the expected value and will tend to become closer as more trials are performed. So let's look at rolling dice. I think we can all agree that rolling a 6 is totally unpredictable. There is technically a 16.7% chance that on any given roll, you get a 6. In this study, the first 5 rolls actually did not produce a 6. But notice that once you get to about 200 tries, the proportions become very predictable. And notice how that line smooths until you get out to 1,000 tries. It's a near perfect correlation when you get out that far on the line. Now, in the previous slide, I said that a 65-year-old man would have an average life expectancy to age 90. What I did not say was what it was based on, which is the 2015 VBT mortality table. The VBT table, which is based on 266 million lives. By any measure, we can call that number large. And by definition, it is very precise. At those volumes, the insurance companies can turn an unknown, into a known. On a single life basis, we have no idea when a person will die. But with a sample space of 266 million, we know with great precision how many people are going to die in any particular year. And how? Because of the law of large numbers. And this is crucial to understand because it underpins the entire value proposition of life insurance. So let's get back to our math example. Here are the sinking funds, funded shorter. So we have the age 90 sinking fund, the age 85 sinking fund, and the age 80 sinking fund. So how much would it take if we were to use life insurance, which incorporates the law of large numbers? What's the deposit necessary? It's $22,764. A little. So, and what else? And what else can the insurance company do because of the law of large numbers? They can deliver the entire $1 million in all years, not smaller amounts, which would occur if the person were to die early. This is the significance of the law of large number. And this slide really sums it up. Every other investment class provides an unknown outcome at a specific point in time. You know, if a client has stocks, bonds, real estate, et cetera, you don't really know what that's going to be if you were to draw a line later. Life insurance provides a known outcome at an unknown time called death. On a single life basis, we have no idea when the person is going to die, but life insurance delivers a consistent result in all years. If you think about it, life insurance is the ideal mortality-based hedging tool. It is a classic asset liability matching tool. We have a mortality-based liability called the estate tax in our example, and we have a mortality-based asset called life insurance to match to it. The moment the liability comes into existence is precisely the time that the asset comes into existence. That is the logic of life insurance at its most elemental basic level. How and why it works as it does is all built on the law of large numbers. And on top of the law of large numbers, let's look at some of the other tax characteristics of life insurance that help explain why many individuals and corporations use it. First of all, it's income tax-free under Section 101A of the Revenue Code. If it is owned outside the estate, it can be transfer tax-free. It can also be, it is capital gains tax-free. It's the one item that can be gifted that carries with it an implied step-up in basis. It is generation skipping tax-free, and it's also a non-correlated asset. It is a mortality asset. No other asset on the client's balance sheet is correlated to mortality. So it is literally a non-correlated asset, which has value. So let's look more deeply at the rationale for life insurance. and look at why affluent families use life insurance. So here's some of the key reasons why. It's a funding source for estate tax. We've already talked about that. The estate tax appears at death. The life insurance appears at death. And it's a tax-favored source to pay those estate taxes. Estate equalization. Imagine someone who has an interest in a business. They've got 3 children. The business is going to one child, and the other 2 children won't inherit any of the business assets, and the business assets are 90% of the estate. Life insurance is an ideal tool as the business is moving to child number 1 for the estate to be equalized among children 2 and 3. Wealth replacement. Often wealthy clients leave money to charity at death. Life insurance is an ideal wealth replacement tool. The moment those assets go off to charity is the moment that the wealth is replaced for the beneficiaries. Wealth transfer, simply as a lever to move wealth intergenerationally because of its efficiency. Survivor income, this is a big one. Often we have very wealthy families. They'll marry, and the surviving spouse at the death of the wealth holder, the family wealth holder, has no resources because those assets are going downstream to the next generation. Life insurance is an ideal tool to provide for non-family beneficiaries, and also as an income source. Sometimes life insurance is used as an accumulation/decumulation tool and used as an income stream for retirement. Kristen will actually talk about that a little bit later. Now, with all this said, life insurance can still be very confusing. Lots of lawyers and CPAs get lost in the difference between term insurance and whole life and index life and variable life and, oh yeah, what is private placement? And where's universal life fit into this? Slide 23, by the way, let's stop for a poll question. How confident are you in guiding clients on life insurance product selection, which is what we're getting ready to talk about? Yeah, please take a moment and answer the question. Do you have high confidence, moderate confidence, or little confidence? So, take a minute and answer that question. This is good. We have much higher confidence than I thought we had, which is good. There's some skilled professionals on the line with experience with life insurance. So it's about a third each. So that's good. So slide 23 is something we call the product landscape. And on it are all the current forms of life insurance. All these products, everything on this chart is underpinned by the law of large numbers. And there are lots of products and types of products represented here. On this page, this one-page chart, a 150-year story of the development of life insurance in the United States is really embedded into this chart. And frankly, the most interesting part of the story has happened in the last 40 years, which exactly matches my career in the life insurance business. I came into this business in 1981, and virtually all the development of new product types and changes has happened in the past 40 years. So let's begin with the basics. The life insurance industry in the U.S. really started for all practical purposes in the mid-1800s. Up until that time, there was no life insurance. When somebody died in the community, all they could do was pass the hat. So the birth of actuarial science really goes back to the mid-1800s when somebody, I don't know who, woke up and said, if we pass the hat before somebody dies, somebody needs to collect and invest that money and then pay the claim when the person dies. Voila! The life insurance industry was formed, and that was the birth of actuarial science. The first policy type was actually term insurance, and I'm going to put a 1 beside that. The insurance company collected the premium, less from the younger people, more from the older people, and paid the claim when due. This is the first product that started back in the mid-1800s. The problem was that when people aged, they dropped out, which defeated the goal. So they knew they needed to address that, so they created a product that someone could have with a level premium throughout their whole life. People often wonder where the name whole life came from. Well, it came because there was a concern that people needed to have insurance for their whole life. So they created a whole life insurance policy. And that was the way it was, 2 products up until the 1980s. It was term insurance and whole life insurance. When an insurance company collects the premium, they have to invest it. It goes into the reserves of the insurance company called the general account, which is the very conservative bond portfolio of the life insurance company. These general accounts are very heavily regulated. You can't have a life insurance company out buying pork belly futures to back up the claims. It has to be invested conservatively, and the rule of thumb is about 95% bonds and 5% other types of assets. Life insurance companies have to be really good bond managers, and the success of the company depends on that. So I said bonds. That's what backs up the policies in the general account. Now, for those too young to remember this, the interest rates began a slow rise from World War II up until the late 70s, and life insurance reflected this, and people were living longer, and there were only two products, term and whole life, and both were very conservatively priced. And then 1981 happened, the year I graduated from college. Interest rates suddenly spiked to 14% for a certificate of deposit. I remember this well because I was in public accounting as a new CPA at the time, and my dad sent me an article from the Wall Street Journal about a new life insurance product called Universal Life. This was groundbreaking. It was a radically different design. It was a whole new product category. Basically, the life insurance company, E.F. Hutton Life at the time, broke apart the whole life policy and created term insurance and a side fund all in one policy. And unbelievably, it credited at that time 10% interest on the side fund. Of course, 10% was not guaranteed, and just the current interest rate based on the prevailing interest rates at the time. And the premiums were projected, and let me emphasize projected, to be much lower than whole life because of the ability to incorporate these higher interest rates into the design of the policy. Again, the pricing was based on non-guaranteed prevailing interest rates. And as you can imagine, those policies ultimately required a lot more premium over time to sustain them once the interest rates began their long decline. Whole life companies did not stand idly by while Universal Life took off. They responded with revising their interest assumptions to current rates, making for a much more aggressively priced policy in order to compete with this new phenomenon called Universal Life. And they started including term riders on their policy as a response to further drive down the premium. In short, they made their policies look a lot more like the new hot Universal Life offering. But as you can imagine, the long decline in interest rates meant more premium had to go into these whole life policies also to keep them performing. And that's what there was, high interest rates and three product types, term, whole life, and universal life. I can't overemphasize how the appearance of universal life was earth-shattering. For over 120 years, the industry had two products, term and whole life, and the introduction of this new form, it ushered in a whole new era of products. And it all stayed the same for a few years until Equitable brought out a new product in the mid-1980s called variable universal life. That's the V in the VUL. The logic for this was that the insurance company allowed policyholders, rather than the insurance company, invest their cash values. In other words, invest in something other than the general account. The policyholders could select accounts to drive the performance of the policy. This was the first time that a life insurance product became what is in substance a security. These policies are broadly called separate account products because the assets are separate. Because the investments backing the policy were totally segregated from the policy. To keep this simple, it meant you could have a life insurance policy with the insurance company responsible to pay the death benefit, but the cash values were literally at an asset management firm off-site, like Fidelity or Vanguard or something else. It was radically different. But one thing about securities is that they are volatile, and this brought more unpredictability to the performance of life insurance, which was okay if you were treating it as an investment or a way to accumulate money, but thinly funded policies that had a substantial reduction in cash values because the market went down, we're having to put more and more premium into these policies. Remember, we've had some very scary corrections along the way, 2001 and 2008, which led to clients asking a basic question, and this happened in the early 2000s. And here was the question. After all this volatility, clients began to ask, Can I just have a policy that is a permanent policy where I pay a premium and get a death benefit with no moving parts? And the answer to that was yes, and a new product was brought to the marketplace called Guaranteed Universal Life. What the carriers did was take a universal life policy and add a rider to it that guarantees all the elements of the policy. The client, if they just paid the premium on time, would have no pricing risk. Okay, so why did I tell you this story? Because it tells you why the majority of the life insurance you see for estate planning purposes is in this Guaranteed Universal Life format. And that is the product that really has been around for only 20 years or so. Not all, but a lot of trust-owned life insurance you will see is in this format. And why is that? Again, an irrevocable trust is typically put in place to benefit the downstream heirs with death benefit. The cash values are not accessible typically to the grantor, and one of the hallmark features of GUL is that it has very little cash value, but a guaranteed premium and death benefit. Think of it as lifetime term insurance. It's been a product of choice for irrevocable trust and estate planning for almost the last 20 years. And you can see why. It's full of guarantees, and it's a good fit for most trust-owned life insurance. And you'll see a lot of that product in ILETs. But the issue with this type of policy is that the pricing risk is transferred to the insurance company. The client doesn't hold the risk. And as lower and lower interest rates have made it tougher and tougher for companies to offer this product. But it's still the dominant form of insurance being put into ILETs because of its guaranteed elements. But these are expensive for companies to offer as rates continue to decline. There are fewer and fewer guaranteed products available in the marketplace. But of course, the industry continues to evolve, which brings us to the development of indexed universal life, which is the most recent iteration. A complete description of indexed universal life is beyond the scope of this discussion, but suffice it to say that IUL has seen a lot of growth. It's essentially a way to get upside equity type performance exposure while managing downside risk. It's not primarily used in the estate planning context, but rather in the context of retirement income planning, mostly. It's being promoted as a tool to put lots of money into the policy in order to grow the cash values and take distributions for retirement income. Kristen will talk more about that. So let's summarize. From a historical standpoint, it all started as whole life in term insurance, two products. Universal life burst onto the scene when interest rates spiked in the 80s. Separate account products came onto the scene when equity markets were on a long positive run. And then GUL came to the forefront as the product of choice for irrevocable trust if the mission was to maximize death benefit and minimize risk. With all that as background, I hope the next slide puts together a logical map of what product to use and when. It's not perfect, but it serves as a useful guide, and we call it the life insurance product mapping tool. So with this, so imagine we have generation 1, generation 2, generation 3. Generation 1 has a shorter life expectancy. The primary death benefit product would be mostly guaranteed universal life and universal life. If the product focuses no cash value, internal rate of return of life expectancy, and a mortality hedge. In other words, typically, if you draw a line down the middle of this right here, you would say these are mostly the death benefit products, and these are mostly the accumulation products with death benefit as a secondary item. That's just in broad strokes. Any of these products can be used for any purpose, but in broad strokes, if you took the products to the left are mostly for death benefit, the products for right are more suitable for accumulations. So with a shorter life expectancy and a focus on death benefit, products to the left are more relevant. And you really don't use accumulation products at those ages. For people in the 50s and 60s, term, GUL, and universal life, all the ones to the left are used as the death benefit product, and whole life IUL, and VUL, or private placement VUL, for the right. Generation 3 for the longer term durations, really any of the products can be rationalized or used, depending on whether there's a focus on death benefit or whether there is a focus on accumulation. So we've talked a lot about, what have we talked a lot about in this segment? We've really talked about the fundamental element of life insurance, which makes it different from other financial instruments. Based on the law of large numbers, we've talked about the unique tax and asset class characteristics of life insurance, as well as a brief historical overview of the development of the product in its various forms along the way to help and giving you a mapping tool so you can map the right product into the right client's circumstances depending on what the goals of the product are. The thing we haven't talked about today is what's needed for a life insurance policy to actually succeed like it's supposed to. And I want to end this segment with what I think is a very, very important observation. First of all, you need to be sure you're picking the right product or products to do the right job. You don't want to use guaranteed universal life if the mission is to accumulate cash value. The policy does not do that. And you don't want to use a product that's built to generate cash value and try to emphasize it to use death benefit. You have to design the right product for the right mission. And this is not a set it and forget it proposition. Once the product's in place, it must be monitored. If the policy goes off track for 20 years and nobody's watching, it can be a mess. And fixing it late in the game can become an even bigger mess. As we say, life insurance works very well if it's well designed, well implemented, and well administered. At the beginning, I said my remarks, I said our goal today is to enhance your understanding of what life insurance is, why it works, and how to be able to give real guidance to clients as they consider using life insurance as part of their estate plan. I hope you feel like the last 25 minutes was beneficial to your understanding. And I would like to now turn the mic over to Kristen Boulat with NFP to talk about modern strategies for putting the life insurance to work to achieve the clients' and advisors' goals. Kristen?
Thank you, Ken. That was such a wonderful explanation of the history of life insurance and really working through the different types of insurance and why you might use them. I can echo the story that you told about when you set yourself the summer project and spoke to lawyers, because I was on the other side of those conversations. Started my career as a practicing attorney and really only used life insurance for estate planning. Back in that time, the rates were a lot higher, and we used to say, we're going to take the estate, cut it in half, and that's how much life insurance we buy. And we bought just for death benefit. So I want to spend the next little bit of time talking through some of the more modern strategies that we have for using life insurance. It certainly is still used, as Ken pointed out, for liquidity, funding, estate tax, wealth transfer. But I wanted to talk about some of the other ways that we use it. And before I get into the modern strategies, we have a poll question. I was just wondering, from all of you, how you most often guide clients to consider life insurance. Do they consider it for income replacement at death, income supplementation during life, estate tax liquidity, business succession, or buy-sell planning? So if you go ahead and answer that. Give it just another moment while I get some answers submitted. Okay, so most of you are doing exactly what I did when I was practicing, and really using life insurance for estate tax liquidity. And as Ken pointed out, that's a really great way of using life insurance. It gives you a known result at an unknown time. You don't need to worry about funding for when somebody's life expectancy, what standard deviation. You have the life insurance, it's there when you need it. But as life insurance has evolved over the past 40 years, it really also, the way that we use it has evolved. So I'm going to talk about some of those different strategies. Life insurance, we want to utilize life insurance. We want to take advantage of the tax efficiencies in life insurance, the tax-free accumulation, the tax-free death benefit, and even the income tax-free access to the policy if done in a particular way. So how do we leverage life insurance and those benefits without creating additional unexpected tax results, such as gifting, estate tax, and even income tax if the policy isn't structured properly? A lot of people, when they were talking about life insurance, want to know why am I waiting until I die and I don't get any immediate benefit from life insurance? Can we use it during my lifetime? Are there what we call living benefits available under the policy? Life insurance has become a really powerful tool in rewarding, retaining, and attracting individual employees. So we'll talk about some of the uses for that. And then also a really interesting way to finance a life insurance with third-party money. can talk to us about funding the death benefit. And, are you going to fund it on your own, or are you going to use life insurance? This chart right here is showing the additional leverage you get by combining life insurance with your own investment strategy, and the fact that you don't have a crossover point to well beyond life expectancy. That's really looking at the death benefit and the way that the death benefit can enhance your overall estate plan and your wealth. But what about that living benefit I was talking about? That comes through the cash value inside the life insurance contract. The slides will be available for you. You don't have to worry about reading all of this. But what we're really looking at is a comparison of, I'm going to put some money into a trust. In this instance, we're using what we call a spousal lifetime access trust. Just gives a beneficiary the ability to access money inside the trust during the insured grantor's lifetime. We're going to fund the life insurance policy. We'll buy a life insurance contract that has cash value accumulation. We're going to then access that cash value accumulation to supplement retirement income. We'll pay it over a short period of time so that it generates as much income tax, as much cash value as possible, and then that will be supplemental retirement income. It's going to function as similar to a Roth IRA in that you're buying it with after-tax money and it grows income tax-free, and you can access it income tax-free. And that supplemental income really provides a nice benefit to the other investments, the brokerage account, the taxable investments, and the qualified plan income tax-free investments. So we're using this strategy to bolster an individual's retirement planning. It gives you that living benefit. You can add a long-term care rider to that contract, allowing you to accelerate the death benefit to cover long-term care expenses. So you get that benefit during your lifetime as well then at death. And we're seeing that be used in the business marketplace as well. Those clients, those individuals that want to have an employee that they retain and reward are using life insurance. There is a growing retirement gap for high earners. The traditional methods of funding a qualified plan do not generally generate enough income for a high earner to replace that salary. So adding the life insurance and that cash value, the ability to access it income tax-free, creates a really powerful tool. There's a couple different plans, different ways of providing this benefit to the employees. We go from a bonus plan, which is pretty straightforward. We're just doing an annual bonus. That bonus is picked up by the employee as taxable income and paid directly to the carrier through the form of premiums. We can increase that bonus so that there's a net, there's enough of the bonus to cover the income taxes due. The bonus plan has some retentive pieces to it. It does not have quite the same keys that you would have the retention of a restricted bonus plan or even a split dollar because there's no repayment. But it also gets liquidity directly to the employee, business deduction, and it's very easy to create and monitor. You also, all of these plans allow you to do their non-qualified plans. You can discriminate. You can pick 3 employees to do it. You can do 5 employees. You can create a different type of plan. Restricted bonus plan is a traditional bonus plan where we have a repayment obligation. There's a rough vesting schedule usually tied to it. That vesting schedule, if the employee leaves before they're fully vested, they have to repay the amount of the unvested amount that usually comes from the cash value. So it has a lot more of a retentive piece of it. However, there's no business deduction until the employee recognizes the income invests in it. Death benefit only plan works nicely in conjunction with key person insurance. That is a policy that's owned by the business. The business has access to the cash value, and then the employee has the ability to name their beneficiary. So they're going to get that death benefit if there's an untimely death. You can also divide the death benefit. So the company gets access to the cash value and some death benefit and the employee gets the balance. And then we have split dollar, which is used in both for-profit and nonprofit organizations. That split dollar is really going to give you different benefits depending on how you structure it. You can do a death benefit focused split dollar plan under a collateral assignment economic benefit, or you can do loan regime split dollar that allows the employee, again, to access the cash value. The real split dollar is more complicated in terms of creating it. It is, however, the only structure that's really going to give the company full cost recovery. So that's an interesting way of sort of doing some of this business planning. There are some questions that I see popping up that I want to kind of jump into because it makes sense in where we're going. Long-term care benefits, if the policy is in a trust, you can access long-term care benefits inside the trust. That long-term care rider is an asset of the trust. It's owned by the trustee. The trustee has the discretion to use or not use that long-term care rider. The benefit is distributed out to the beneficiaries. If you're doing a traditional spousal access trust, where you have a spouse who's a beneficiary, the spouse then has the long-term care benefit that's distributed out of the trust and can use it for long-term care needs. If you don't have a spouse and you are using a child or somebody else, there's the possibility of having to make a gift back to the individual. So we do put long-term care riders inside the trust. I don't necessarily love that idea because you have this money inside the trust. It's free from taxes, not reachable by creditors. We can accelerate it or not as we need to. Makes sense sometimes to just put the long-term care rider on a policy that's owned inside the estate. So if we're really focused on long-term care riders, we can put a small policy in the estate with a rider, make a charity the beneficiary of that policy. Then we're not inflating the estate, but we do have access to a long-term care rider. If the long-term care rider is, that would be nice to have it in, but we think we have other ways to cover long-term care, you can put it inside the trust. You can use reimbursement or indemnity riders with it inside the trust. It's just usually a little bit less efficient. But if we're looking at a policy that we really are looking at it for cash value, and then we think we're going to end up needing to accelerate the death benefit for long-term care purposes, you could put that inside the estate. As you pull out the cash value, it does tend to pull the death benefit down, and then the death benefit is, so we're reducing the death benefit inside the estate as we're pulling out cash value. It's coming back down, and then the long-term care rider would further accelerate the death benefit. So it's not likely to be a dramatic increase in the overall taxable estate if we put the long-term care rider inside the estate. Back to our modern uses of life insurance, commercial financing. A lot of people have said, I finance my business, I finance my house and my car. Most of my major assets are financed. Why can't I finance life insurance? And you really actually can. Particularly now, it's pretty easy to get access to inexpensive money. The credit markets are pretty strong. We can finance the life insurance. We create an ILET, my flow chart here, create an ILET. The ILET is going to borrow, they're going to own the policy, they're going to borrow the money from the lender. We need to put up collateral usually while the policy generates enough cash value so that it can become its own collateral source. There are a couple different ways we do that. We can have the grantor put up collateral. If we're concerned about creditor or state inclusion, we can charge a credit fee. The other thing we see a lot that's quite efficient is the grantor makes a gift to the trust using up available exemptions. The trust now has the cash it needs. That cash is used to cover loan interest back to the lender and to provide collateral until the life insurance policy is sufficient to support the collateral requirements for the lender. Usually we fund the policy as quickly as possible without creating a modified endowment contract. So depending on the age of the insured, that's usually 7 to 15 years. And then we have a couple different ways to exit that financing. Sometimes the cash value of the policy, sometimes the other assets, or sometimes the death benefit, depending on the funding, the age of the insured, and the type of policy that we're using. When we're doing commercial financing, there are several considerations we need to look at. We need to look at how we're going to fund it. So the uses for premium finance life insurance, liquidity need. Premium financing is a really great strategy for short-term liquidity requirements. We know that there's going to be a sale of the business where this asset's going to be developed and then we're going to be able to sell it. Or there's a grant that we've put in place and it will drop into the trust. So it provides liquidity, leverage. A lot of people that do highly leveraged businesses, such as builders and real estate, they understand the value of leverage. We can combine it, it's flexible, and the life insurance policy itself is really designed to utilize commercial financing. When we're doing commercial financing, you do need to have some things to be aware of. How are we going to pay the interest? If you're looking at a commercial financing proposal that shows that we're rolling up all the interest, that's a financing proposal that could go sideways. If we have unexpected interest rate increases, we want to know, where's that interest coming from? What's the funding source? Are we doing annual gifts? Is there money inside the trust? Other assets? What's our collateral source? Did we design the policy to fit the overall strategy? Are we exiting? How are we exiting the financing? The policy design and the exit usually go hand in hand. Are we exiting from death benefit? Did we buy an increasing death benefit policy or a policy that has a return premium rider on it? So we use the exit that way. Are we exiting from the cash value of the policy? Also, the interest rate assumptions. What interest rates are we looking at? How long can we lock in an interest rate? Can we lock in a spread? The way that the finance markets are currently, I've seen the ability to lock in a spread for a certain number of years, or even an interest rate for quite a few years. What policy performance assumptions? So when you're looking at premium financing, make sure that we're comfortable with the policy performance, and then also the combined strategies. Are we using other strategies for the exit? Are there going to be gifts? Is there a private loan to the trust? Is there a grant in place? Is the trust already funded? We're looking that there's going to be a liquidity event. So commercial financing of life insurance in conjunction with other financing strategies is a really efficient way to fund life insurance. Now, we're going to move on to what's up with Washington. There's been a lot of talk about Washington. We've all been paying attention. We've been talking to people in Washington. I can tell you where we are at the moment, but this is just part of the conversation. So none of this we really know for sure. We won't know anything until we see some signed legislation. But before we get into where we are, we have another quiz, a poll. One of the things that I've seen a lot this year is a real shift in strategies, people speeding up their strategies. There's been perhaps an anticipated increase in the capital gains tax rate. So people are looking at maybe selling assets or businesses. They're looking at maybe doing larger gifts. So the questions really are, how do you talk to your clients in light of potential tax legislation changes? Are you suggesting that your clients move more quickly? We're going to try to get out in front of an anticipated change. Are you saying to your clients, what we're doing for you, this planning, this makes sense for you and your family and your long-term strategies. We don't need to necessarily speed it up. We are comfortable. We've created a flexible plan. Or are you suggesting to your clients that maybe we just pause, wait and see what happens in Washington? I have had some attendee submissions, so let's see our results. Most of you have suggested to clients that you move quickly to anticipate the changes. That's pretty consistent with what I've heard sort of across the board, where, we're going to do the planning we would have done anyway. We'll make the large gift. If we don't see a reduction in the gift tax exemption amount, we still made the gift. We transferred appreciation out of the estate. We're not any worse off than we would have been. So as of the moment, what's up with Washington? Nancy Pelosi has said that the House will not recess. Reportedly, she said that the House will not recess for Thanksgiving without having voted on the reconciliation package. And once the House votes, it will need to go over to the Senate, where all of the Democrats of the Senate will need to agree to the strategy, to the bill. So there's a lot of negotiating happening right now, and it really seems to be among the chambers, not within the House. So the bill that we see coming out of the House will likely to be one that the Senate is likely to sign off on. At the moment, the grantor trust legislation changes has been taken out of the bill. The accelerated sunset has been removed from the bill, and there were no significant changes to the estate tax overall. But again, we have not seen anybody. There's been no voting in the House and certainly not any voting in the Senate. So we don't really know where we're going to be. We may end up here. We may find some of those provisions that were in the first draft coming back around again the second time. As more things are added to the bill, the CBO budget score comes out. It's supposed to come out by Friday. If that budget score is not where it's expected to be, there may be some need to do revenue raising, and some of those things that were out of the bill may come back in. So it's a situation that's really in flux. It's very fluid, and so we're trying to do some planning still. Let's keep going with planning that makes sense for clients, that gives flexibility, but also could really respond to potential changes in the tax law. So we have about 4 minutes left. Few more questions and some additional information. That Ken is going to come back on the line with us. He's been patiently waiting. We're going to talk about what's going to happen in the future in light of this potential tax law changes, and then also how do you help your clients find a life insurance policy, a trustee, really set themselves up for success in the future. So Ken, welcome back to the discussion.
Thank you. So I love this quote from Jeff Bezos. He says he's always asked what's going to change in the next 10 years. He says, you know what, that's a good question, but the better question is what's not going to change in the next 10 years. And that is nice in that it brings us to the topic of how to select a trustee. And we'll close with this. The bottom line is that an instrumentally important part of the success of a life insurance is the success of the trust that it's sitting in. And in order for a trust to succeed, it has to have a trustee that is competent and engaged and elicits or manifests these 6 things that are on the slide, which is they've got experience, they stay current, they confidently make decisions, they accept responsibility, they're objective, and they communicate really well. In my experience, this is just my experience, individual trustees are often asked to serve this role, but unfortunately, in a lot of cases, they really don't understand the breadth and scope of their responsibilities, and sometimes the trust don't move along as they should because the trustee isn't really as knowledgeable as they could be. It's just a nice brother-in-law who's trying to help the family, but they don't really understand their role as trustee. So there's a lot of benefit in having a good corporate trustee, and there are some good corporate trustees out there. But the differentiator among those corporate trustees is that some take the life insurance as an accommodation, and it's not really what they want, but they will accommodate it. And there are others who really want it and who do a great job and are enthusiastic about really providing services to the trust. And that's a very, very important consideration is, do they really want this type of asset? And that is very, very important. So those are some, in light of the time, we can only just spend a moment on that, but hopefully we've communicated the importance of properly selecting a good trustee. And so with that, unless there are questions that we can answer, I wanted to, I guess, turn it back to Susan.
And
Thank
there
you.
Sorry, there were just a couple of questions that I thought we could knock out quickly, if you don't mind, Susan, and sort of wrap it up.
I don't mind, but I think John Barkhurst wanted to say a few words before we went to the questions. So I'm going to let him do that, and then we'll go to the questions.
Yeah, sure. Thanks, Susan. And thank you, Kristen and Ken. Fantastic job, on behalf of Life Insurance Trust Company and ITM. We greatly appreciate your willingness to share your insights on the topic today, and very timely and relevant information, and no doubt will be an invaluable resource for so many of the estate planning practitioners in attendance today. So again, thanks to everyone who participated in today's webinar event. If you would like to learn more about some of the unique ILET fiduciary and support services that we're offering at Life Insurance Trust Company or ITM, please don't hesitate to reach out. We welcome the opportunity to learn more about your practice and how we may be able to partner with you and your ILEC clients. So with that, I'll turn it back over to you, Susan. I know there's a lot of questions, and if we are not able to get to your questions in the next few minutes, we'll certainly follow up with you directly and make sure that you get an adequate response. So thanks again.
All right, Kristen, why don't you take a few of the questions?
Sure, I'd be happy to. So somebody asked if you can use no cash value insurance as collateral. Generally not. The third-party financer, it's usually a bank, or there are some finance companies that specialize in financing life insurance, not the insurance carrier themselves. So the financing comes from a third party. They don't if they're going to use the life insurance policy as collateral, they want to be able to see that they can access that collateral without having to necessarily wait till death. So not using, having cash value would not make it appealing to the funder in terms of the collateral source. One of the other questions was, this one I thought was interesting. What if we buy life insurance for estate tax purposes and then the tax law changes? So we all remember 2009 when we had no estate tax. And, I had a lot of clients that had a death in the family during 2009. There was no estate tax. They had a lot of life insurance. Not a single one of those families said, wow, I really am sorry we had that life insurance. There's never a beneficiary that says, I don't want tax-free liquidity, I'm good at it. So even if the tax law changes, if let's say got rid of an estate tax for some reason, the estate tax went away, life insurance and the death benefit that it provides on that tax-free liquidity still always has value, whether we're looking for liquidity, it's in a business context. So we use it to fund for estate taxes, but in reality, there's a lot of other reasons for the life insurance death benefit. And then, let's see, Ken, there were a couple other, let's see, the SLAT question. I'll make this one my last one, and then we'll follow up. As everybody said, we can follow up with you afterward. If you have an insured grantor who's unmarried, they're unmarried when they create the SLAT, they maybe no longer have a spouse when they go to access the money. There are a couple different ways that you can access the benefits and cash value. One is to just borrow the assets from the trust. You can do an interest-bearing secured note if you wanted to. Accrue the interest, that becomes a debt of the estate. We use estate assets to repay that loan amount. I've also seen situations where we set it up in a state where there's decanting, so we can decant it to a different trust. Maybe we use the power to swap assets. We put other assets in, get the life insurance out, or we use, second generation as a beneficiary, and then they make the gift back to the individual. So couple different ways to access that cash value and living benefits if you don't have a spouse, but you did create a spouse access trust or you still want to do one.
We've gotten a number of questions, maybe over, I don't know how many, asking for the slide deck, which I would like to make available. Very flattered that people like the slide deck. Isn't that nice, Kristen?
It is.
I want to make that available. So,
Okay.
Hosts will take care of that.
Right.
Yeah,
I think that's the end of our.
It is the end. So thank you.
Okay, thank you. I want to again thank our speakers, Kristen and Ken, for really an outstanding presentation. And also, I would like to thank Life Insurance Trust Company for making today's webinar possible. As a reminder, you'll receive a follow-up email that will include a link to view a recording of today's presentation. So if you found this event useful, please share it with your colleagues. Once you leave the event, a short survey will pop up in your browser window. We'd appreciate it if you'd share your feedback on this event, as it helps us to provide you with the content that's most interesting for you. And again, the attorneys in the audience, please remember to put the code word in the survey. On behalf of Trust and Estates, have a great day.